Ma'am, we need you to step away from the desk and come with us.
This is Diane Collier, franchise accountant. To the owners who trusted her with their books, she was the most reliable person in the building, the one who knew every number, every vendor, every audit cycle.
I don't understand on what grounds, and how did you people even get in here?
To federal investigators, she was the architect of a 22-year embezzlement operation that quietly drained $430,000 from the franchise, while nobody looked twice at the woman holding the pen. Within 48 hours of her arrest, investigators would trace fraudulent checks across 6 shell vendors, flag 214 unauthorized transfers, and recover purchase records for a lakeside property, 2 luxury vehicles, and a private school tuition trail spanning 9 years. By the time this footage ends, the most trusted name in that building will be the most wanted. Here's what most people don't realize about how a McDonald's franchise actually runs. There are over 40,000 McDonald's locations worldwide, and the vast majority are owned by independent franchise operators, regular people who took out loans, signed contracts, and bet their savings on golden arches. Most of these owners manage between 3 and 5 locations at the same time. They're handling staff problems, supply orders, customer complaints, and health inspections every single day. They don't have time to sit down and check every number on every invoice, so they hire someone they trust to do that for them. That's where the accounting office comes in. And in a setup like this, the bookkeeper isn't just an employee. The bookkeeper is the financial system. There's no big corporate finance team watching over their shoulder. No rotating auditor coming in every 6 months to ask hard questions. In most small franchise groups, one person controls vendor payments, writes the checks, and keeps the records. All 3 jobs. One person. The specific app Diane Collier found was simple. She had single signatory check authority, meaning she could approve and issue payments without a second signature. Vendor approvals ran through her desk alone, and there was no requirement for an outside audit, ever. The owners reviewed profit summaries at the end of each month, not the individual checks, not the vendor list, just the bottom line. They built the system for speed. They built it for efficiency. They built it on the assumption that the person they trusted most would stay trustworthy. The system was not built for someone who had spent 2 decades learning exactly where it couldn't see. If you've never seen how fast a trusted employee can dismantle a business from the inside, stay with me. And if you're new here, subscribe. This is the kind of story we cover every week. Diane Collier did not grow up with money. She grew up watching it, counting it, stretching it, and learning very early that in her household, every dollar had a job to do. Her family wasn't in crisis, but they weren't comfortable either. They were the kind of family that checked the receipt before leaving the store, the kind that knew exactly how much was in the account before writing a check. Money wasn't something that flowed freely in that house. It was something you managed carefully, or it disappeared. Most kids in that environment learned to fear money. Diane did something different. She got fascinated by it, not by spending it, by how it moved, where it came from, where it went, and who was responsible for making sure the numbers added up at the end of the week. While other children found that kind of detail boring, Diane found it satisfying. There was something that made sense to her about a clean ledger, a balanced column, a paper trail that told the whole story without a single word. By the time she was a teenager, she was already the kind of person adults handed responsibility to without thinking twice about it. She was organized. She was calm. She asked the right questions and never had to be told something twice. Teachers noticed it. Neighbors noticed it. And when her family's church needed someone to help track donations and manage the small fund they kept for community meals, they asked Diane. She was 16 years old, and she was already learning how institutions handle money. That church treasurer role taught her something that no classroom ever could, that most organizations, even ones built on honesty, have gaps in how they watch their own finances. Not because the people running them are careless, but because they're busy. They're focused on the mission, on the people, on the day-to-day work. The financial side runs on trust. Someone has to be the person everyone believes in, and once you become that person, almost nobody checks your work. She filed that away without even knowing she was filing it. After high school, she took a cashier job at a grocery chain and was moved to the bookkeeping office within 8 months. She was faster and more accurate than people twice her age, and her manager didn't waste time leaving her at the register. From there, she picked up part-time work as a bookkeeping assistant for a small local business. Payroll, vendor invoices, bank reconciliations. The kind of back-office work that keeps a business alive but never makes it into any headline. Each job gave her a new piece of the picture. How vendors get added to a payment system, how invoices get approved, how checks get issued, how often the person at the top actually looks at the details versus just the summary. She wasn't cutting corners at any of these jobs. Her employers loved her. Her work was clean, her records were tight, and she showed up every single day. But she was also building something without realizing it. A complete mental map of how small institutions handle money, where the busy spots are and where the quiet corners are that nobody ever walks down. She wasn't dangerous yet. She wasn't even thinking that way yet. She wasn't planning anything. She was just learning how money moves and who watches it. Diane was in her late 20s when she first walked into the franchise group's administrative office. The job posting was straightforward: part-time bookkeeper, flexible hours, experience preferred. It wasn't glamorous. It wasn't the kind of position people dreamed about. But for Diane, it was exactly the kind of room she had spent her entire working life learning how to enter. She got the job without much competition. Her references were clean, her experience was solid, and she interviewed the way she did everything else: calm, prepared, and precise. The franchise owner, a man managing 3 locations at the time with plans to expand, needed someone who could handle the back office without needing their hand held. Diane made it clear, without overselling herself, that she was exactly that person. She started part-time, came in 3 days a week, handled vendor invoices, reconciled the bank statements, kept the payroll records in order. Nothing flashy. But within the first few months, the owner noticed something that is surprisingly rare in a back-office employee. She didn't create problems. Most bookkeepers, especially new ones, come with questions, errors, delays. Diane came with finished work, clean files, no surprises. By the end of her first year, she was full-time. By her 3rd year, she was the only accountant the group had. As the franchise expanded from 3 locations to 5, the financial workload grew, but the oversight structure didn't grow with it. The owner was now splitting his time across multiple sites, dealing with staffing shortages, equipment repairs, and the constant pressure of hitting corporate performance targets. He needed the financial side of the business to simply run, quietly, reliably, without pulling his attention away from everything else he was managing. Diane made sure it did exactly that. The promotion came during a meeting that lasted less than 10 minutes. The owner slid a folder across the desk that gave her single signatory check authority, meaning she could approve and issue payments on behalf of the business without a second signature. He also handed her full control of vendor management, which meant she was now responsible for adding vendors to the system, approving their invoices, and authorizing their payments. All of it. One person. "I don't have time to be in the weeds," he told her. "That's why I have you." She nodded, picked up the folder, and went back to her desk. Her performance review from that same year described her in terms that would later be deeply painful to read back in a courtroom. It praised her discretion, the way she handled sensitive financial information without ever discussing it outside the office. It praised her accuracy, not a single reconciliation error in 3 years. And it singled out her initiative, the way she identified problems before they were brought to her and solved them before anyone else noticed they existed. Every single quality they praised her for was real. That was the thing. She hadn't performed any of it. She genuinely was that good. But those same qualities, the discretion that kept her work private, the accuracy that made her records look clean, the initiative that meant she was always one step ahead of any question someone might think to ask, were about to be pointed in a completely different direction. She now sat at the center of every financial transaction that moved through that franchise group. Vendors, checks, invoices, payroll, all of it passed through her hands and her hands alone. She now controlled every dollar that left those restaurants, and no one was checking her work. To understand what Diane did, you first need to understand how money moves through a franchise operation on a normal day, because the scheme only makes sense once you see how simple the system actually is. When a McDonald's franchise location needs to pay a vendor, a cleaning company, a food supplier, a maintenance contractor, the process works like this. The vendor sends an invoice to the accounting office. The accountant reviews it, confirms the amount, and issues a check or authorizes a bank transfer. That payment gets logged in the books under the appropriate expense category. At the end of the month, the owner sits down with a profit and loss summary, a one-page document that shows total revenue, total expenses, and what's left over. If the numbers look reasonable, the owner moves on. There are 3 more locations to check: a staffing crisis at the drive-thru and a corporate inspection scheduled for Thursday. Nobody is reading every line. Nobody is pulling up the check register and matching each payment to a physical invoice. That level of detail review almost never happens in a small franchise group, not because the owners don't care, but because they hired a trusted accountant specifically so they wouldn't have to. That was the vulnerability, and it had a very specific hiding place. Inside the profit and loss summary, there is a category that exists in nearly every small business's books. It goes by different names, but the most common one is miscellaneous operating expenses. It's a catch-all line, a place for small costs that don't fit neatly into other categories. Cleaning supplies, minor repairs, one-off service fees. On a monthly summary, that line might read $3,400. The owner sees it, recognizes it as roughly normal, and turns the page. Nobody asks what specific items make up that number. Nobody checks the receipts behind it. Diane had been staring at that line for years. She knew exactly how much variance it could absorb before anyone would think to ask a question. Her method in the early stages was clean and careful. She would take a real vendor, a cleaning supply company the franchise already used, and create a second, slightly altered invoice for services that were never actually performed. Same vendor name, same general format, just a different job date and a different amount. She approved the invoice herself, issued the check herself, and logged the payment herself. The expense landed in miscellaneous operating costs and disappeared into the monthly summary without leaving a ripple. Later, she moved further. She began building fictitious vendors from scratch, company names that sounded real, with PO, boxes she controlled, and bank accounts she had opened specifically to receive the payments. She added them to the vendor system herself, approved them herself, paid them herself. The first fraudulent check she ever wrote was for $1,200. It was made out to a cleaning supply vendor that did not exist, drawn on the franchise account, and deposited into a personal account she had set up 3 weeks earlier. She drove to the bank on her lunch break. No flag, no phone call, no question from anyone. She sat in the parking lot for a moment after she came back out. The money had moved. The books still balanced. The world had not ended. And then she drove back to the office and finished the rest of the day's work. She had found the edge of the map, the place where the system stopped looking and the open space began, and there was nothing on the other side of it. The first year, she took a little. Careful, measured amounts that barely moved the needle on any single expense line. A few hundred here, 1,000 there. She stayed well inside the range of normal variance, the kind of fluctuation that any busy business owner would wave off without a second thought. She was testing the system the same way she had always studied systems, quietly, methodically, and with complete patience. By year 3, the amounts had grown. Individual transactions were climbing into the thousands. The method had also gotten more sophisticated. She wasn't just inflating real vendor invoices anymore. She had built out a small network of shell vendor names, businesses that existed only on paper, with names generic enough to blend into any expense report. Prestige Property Services, Metro Supply Solutions, Premier Facility Group. Each one had a mailing address, a bank account, and 0 actual employees. Each one existed for a single purpose. She also added a ghost employee to the payroll, a name, a social security number, and a biweekly direct deposit that landed in an account she controlled. On paper, the franchise group had one more part-time staff member than it did in real life. In practice, Diane had just given herself a second salary. By year 5, the operation had found its full speed, and it did not slow down. The money had to go somewhere, and this is where the paper trail that investigators would eventually follow began to take shape. Not in the accounting office, but in her life outside of it. In 2015, she paid cash for a Cadillac Escalade. Black, fully loaded, the kind of vehicle that costs more than most people's annual salary. Cash transactions of that size get reported to federal authorities automatically. That report sat in a database. Nobody connected it to anything yet. In 2019, an Acura MDX was purchased and registered in a relative's name. A lakefront vacation property was acquired through a private sale, and for 9 consecutive years, tuition payments for 2 children at a private school were made on time, every semester, without a single missed installment. Her salary was $52,000 a year. None of it added up, but nobody at the office was doing that math. What her colleagues saw was a woman who was good at her job and generous with the people around her. She bought lunch for the office regularly. She remembered birthdays. She was calm during stressful periods and steady when problems came up. If anything, people felt slightly grateful to work near someone that composed and that reliable. She was not flashy about what she had. She didn't show up talking about vacations or making people feel small. She just quietly lived a life that her paycheck could not have supported. And the people who saw her every day never thought to wonder why. That is how this kind of scheme survives for 2 decades. Not through genius, through normalcy, through being so steady and so present and so trusted that the question never comes up. If you're watching this and you've made it this far, do me a favor. Hit that like button and subscribe if you haven't already. We break down cases like this every single week, and you do not want to miss what's coming next in this story. Because at the peak of this operation, Diane Collier was not skimming from the edges anymore. At the peak, she was moving more money out of those franchises per month than some of the stores were clearing in profit. It didn't end because someone got suspicious of Diane. It didn't end because she made a dramatic mistake or got greedy in a way that was suddenly obvious. It ended the way most long-running financial schemes eventually end, because the outside world changed in a way she hadn't planned for. The franchise group was expanding. A 4th and 5th location had been added, and with that growth came the decision to bring in a regional controller, an outside finance professional whose job was to review the entire operation and make sure the books were clean before any new investors came on board. It was a routine business move, the kind of thing that happens during growth phases all the time. It was also the first time in nearly a decade that anyone outside the accounting office had looked closely at the numbers. The controller started the way any good financial reviewer does, methodically, without assumptions, just following the data. She pulled vendor lists, cross-referenced payment histories, and began building a picture of where the money had been going. Most of it looked normal. Routine expenses, familiar vendor names, nothing that jumped out immediately. But then she found something small. 2 vendors in the system shared the same P.O. box. Not the same street address, the exact same box number at the exact same mailing facility. That kind of thing can happen by coincidence, but it's also a classic marker of fraudulent vendor accounts created by the same person. She flagged it and kept pulling. One of those vendors had no website, no business registration on file with the state, no phone number that connected to anything real. It existed in the franchise's payment system, had received tens of thousands of dollars over several years, and left no footprint anywhere outside of those transactions. She brought her findings to the franchise owner in a meeting that lasted under 30 minutes. By the time she finished walking him through what she had found, the owner had gone very quiet. He contacted the IRS the following week. The State Financial Crimes Unit was notified shortly after. A forensic accountant, someone whose entire job is to trace money that was specifically moved to avoid being traced, was brought in to go through every transaction the franchise group had processed over the past 10 years. What the forensic accountant found in the check register became the centerpiece of the entire case. During a cross-reference of vendor ACH routing details, the bank account numbers that payments were sent to. One vendor's account number came back as a direct match to a personal bank account registered in Diane Collier's name. She had used her own account. She had altered one digit in the routing entry and changed the account holder name on file, apparently believing that was enough distance between herself and the payment. It was not enough distance. Investigators now had a direct financial line between the franchise's outgoing payments and Diane's personal account. From that single thread, the full picture began to unravel. The shell vendors, the ghost employee, the cash transactions, the property purchase, and all of it connecting back to the same source. While the investigation built around her, Diane kept her normal schedule. She came in every morning, she answered emails, she filed reports, and at some point during those weeks, she booked a vacation for the following year. She had operated without consequences for so long that she had simply stopped imagining they were possible. She had no idea the walls were already closing in. It was a Tuesday morning, 8:47 a.m. Diane had arrived at the office at her usual time, done what she always did first, started the coffee maker, set her bag down, pulled up her computer. The office was quiet the way it always was before the day got moving. Familiar sounds, familiar light, familiar routine. 22 years of the same morning, give or take. She was pouring her first cup when the door opened. 3 federal agents walked in. They were not loud about it. They didn't rush. They moved with the calm, deliberate pace of people who had already decided how this morning was going to end and had no reason to hurry. Behind them, stepping through the same door, was the franchise owner. That detail was not an accident. Investigators had specifically asked him to be present. They wanted her to see him walk in with them. They wanted her to understand, in the first 3 seconds, exactly how complete the situation was. To her credit, or perhaps out of pure reflex, she didn't fall apart immediately. She set her coffee cup down. She straightened slightly, and when the lead agent introduced himself and told her they needed to speak with her about the franchise accounts, she looked at him with an expression that people in that office would have recognized immediately. Calm, composed, in control. "I think there's been some kind of mistake," she said. "Those numbers, whatever you've been looking at, they're wrong." The agent didn't argue with her. He pulled out a chair across from her desk and sat down. His colleagues positioned themselves quietly on either side of the room. "I want to call my lawyer," she said. Her voice was still steady. "You'll have that opportunity," he told her. "But first, I want to show you something." He placed a folder on the desk in front of her and opened it. Inside was a printed copy of the check register, her check register, the one she had maintained herself for years, with certain entries highlighted. Next to each highlighted payment was a corresponding bank record showing exactly where that money had landed. Her name, her account, over and over and over again, across more than 2 decades of transactions. She looked at the folder. She didn't speak. The room was completely silent. Whatever she had planned to say next, whatever explanation she had kept ready in the back of her mind for a moment like this, just in case, it didn't come. The folder was too complete. The trail was too clear. There was no version of those documents that left any room for a misunderstanding. The agents gave her a moment. Then they stood and told her she was under arrest. She didn't cry when they read her rights. She didn't cry when they put the handcuffs on. She held herself together through all of it with the same composure that had defined her for 22 years in that building. What broke her was simpler than any of that. As agents began moving through the office, bagging her company laptop, disconnecting the external hard drive from her desk, picking up the handwritten ledger notebook she kept in the top left drawer, the franchise owner turned around and walked out the door. He didn't look back. He didn't say a word. He just left. That was the moment her face changed. The office she had run alone for 22 years was photographed, cataloged, and sealed behind her. The legal process moved quickly once the forensic evidence was fully assembled. Diane Collier was charged with wire fraud, money laundering, and filing false tax returns. The charges covered 22 years of transactions, hundreds of individual fraudulent payments, and a total loss figure that had been calculated down to the last dollar. Her legal team reviewed the evidence. Then they reviewed it again. There was no credible path to a not guilty verdict. The check register cross-reference alone was enough to anchor the entire case. Add the shell vendor records, the ghost employee payroll entries, the cash vehicle purchase reports, the property records, and the 9 years of private school tuition payments, all of it documented, all of it traceable, all of it pointing back to the same person, and a trial would have been nothing more than a public reading of her own paperwork. She pleaded guilty on all counts. The sentencing hearing was where the full weight of what had happened was finally spoken out loud in a room she couldn't walk out of. The judge did not focus on the dollar amount. He had seen large fraud cases before. What he focused on was the specific nature of the trust that had been broken. He spoke directly about the franchise owners, not corporations, not faceless institutions, but working people who had taken significant financial risks to build something of their own. People who had signed personal loan guarantees, put their retirement savings into these businesses, and made the decision to trust one person with the financial health of everything they had built. He described the damage not just in dollars, but in the years of work those dollars represented. The sleepless nights during slow months, the decisions made on thin margins. All of it quietly undermined, year after year, by the one person sitting closest to the money. Diane Collier was sentenced to 63 months in federal prison. She was ordered to pay $430,000 in restitution. The lakefront vacation property was forfeited. Both vehicles, the Cadillac Escalade and the Acura MDX, were seized. The private school tuition payments were flagged in the financial record but could not be recovered. The consequences did not end with her sentencing. During the investigation period, the franchise group's cash flow had taken serious damage. Payments had been frozen, accounts had been audited, and the financial uncertainty had made it impossible to keep all locations operating. One store was forced to close permanently. 14 employees lost their jobs, people who had nothing to do with what happened, who had simply shown up to work every day and found themselves out of a position because of decisions made in an office they never entered. The franchise owner gave a single public statement after the sentencing. He didn't talk about the money. He said, "I stopped sleeping. I kept asking myself what I missed, and the answer was I trusted her completely." That sentence is the whole story. After everything was settled, the franchise group rewrote its financial controls from the ground up. Dual signatory approval is now required on every check over $500. An independent third-party audit is conducted every year without exception. The system that ran on trust now runs on verification. It took $430,000, a closed location, and 14 lost jobs to get there. 22 years. One assumption. A system built on trust, exploited by the one person everyone trusted most. If this case made you look twice at the people handling your business finances, it should. And if you want to see how deep this pattern goes, next up is a school district treasurer who hid $800,000 in plain sight, buried inside the one budget line nobody ever audited. That video is right here. Don't go anywhere.